This is your exact guide on how to get started in the stock market. And I mean step by step, very, very, very broken down for you. So many videos on YouTube about how to get started, but they're so vague and they don't give really specific steps. So I'm gonna give you specific steps. This is stock market for dummies, all right? That's what we're going into today. Before we get into that, if you're new here, welcome. I'm glad you're here. Go ahead and subscribe, and you'll learn all types of things about personal finance and investing and all that. My name's Austin. I'm a co-owner of cloudmusicsuite.com. I'm a stock market investor. And after you hit that subscribe button, I'll show you a beautiful picture of my kitty cat. Her name is Millie, all right? Isn't she so sweet? She's actually right over there. She likes to stay in the room when I record. It's wild, okay? She likes to learn about, stocks and investing. She's big brain like that. Anyway, so I got a comment, all right, that said, could you do a vid on investing? I was like, of course I can do a vid on investing, okay? What do you want to see? They said stock market for dummies. So if you want to see something specific, drop it in the comments down there. I'll do my best to make a video on it. Let's get into this thing. So first step for investing in the stock market is going to be to make an account. I know that sounds so obvious, but that step can be daunting to some people, and they're going to stop because they don't know how to navigate that first step. So first step is to make an account. And there's three main options that I think would be something you should consider if you're a brand new beginner. Number one is what companies call a brokerage account. All right, it's just a good old brokerage account. Number two would be a Roth IRA, and then number three would be a traditional IRA. So to open an account with someone who's respectable, like I'm gonna give two main options: Fidelity Investments, proven team, not gonna lose your money with all this craziness in the financial markets. You know, some of these companies are bound to go under or get acquired, and then you're gonna have to go through a little transition. Fidelity, very stable. Charles Schwab, very stable. I'll put pictures up on the screen so you can see these. But Fidelity and Charles Schwab both are gonna have the options that I'm talking about here. And the options are a traditional or an individual brokerage account where you can invest into stocks, ETFs, and a lot more. But those are the two asset types we're gonna talk about in this video because those are the majority of the market, okay? Or you could open a Roth IRA or a traditional IRA. A Roth IRA is going to be one where I don't get a tax break right now. I just contribute my after-tax money from my income. And then after I turn 59 and a half, I can take that money out tax-free, which is very incentivizing. Or you could do a traditional IRA. Traditional IRA is I get a tax break right now, so I can adjust that against my income, lower my tax burden this year. But whenever I take this money out after 59 and a half with these retirement accounts, I'm gonna have to pay taxes on that, all right? So it's up to you, totally up to you. I prefer having a brokerage account, which is an individual, just an individual brokerage account. It's not tax advantaged. I have to pay tax if I sell my investments. And I like to have a Roth IRA. So I max out that Roth IRA, and then all my other investing money goes into my individual brokerage account, which does not have tax advantages. So there's always a catch with these retirement type accounts where you have to wait a certain period of time in order to take your money out. So that's another thing to consider. If you don't want your money to be stuck in there, go ahead with the traditional individual brokerage account, all right? Okay, that's enough I've said on that. First step, gotta make an account. So brokerage account with either Fidelity or Charles Schwab. Those are two very, very good options. Or a Roth IRA or a traditional IRA. That's up to you what you choose to make. One of those three accounts is gonna be a good option to start, okay? Next step from there, I need to fund that account with my money, okay? They're gonna ask you when you're making this account, where are you gonna fund this from? One of those options is my income, my job, okay? So you're probably gonna take money that you save on a monthly basis, and you're gonna fund your account with that. The first funding of your account does not need to be a lot of money. Don't feel like you need to wait until you have 10K. Don't feel like you need to wait until you have even 1,000. You can just do it with $50. There are so many reasons to not start investing, and one of those reasons that you're gonna add on to that is, I don't have enough money yet. It doesn't matter. It doesn't matter, okay? The amount of money that you invest at first is not the amount of money you're gonna have for the rest of your life, you know what I mean? So investing $50 is just gonna get the ball rolling. It's gonna get your mind around like, okay, this is how this process works. I understand how to contribute money to my account. I understand how long it takes for that money to hit my account, etc. Ooh, real quick, I just thought about this. A lot of these companies want you to have a margin account. You should probably have a cash only account. So sometimes, I don't know all the different names, but it's gonna be something along the lines of cash only account. That means you can only spend money that you have in there. There's something called a margin account where you spend borrowed money. Not a good idea. Definitely not for a beginner investor. And honestly, I don't even think it's worth it for an experienced like 10 plus, 20 plus years investor. I stay away from margin accounts. So if your account says margin on it, see if you can switch that over to a cash only account or just choose the cash only option. Okay, so you funded your account, you made your account, you've done those 2 steps, okay? If you haven't done those 2 steps, pause the video, go do that, come back, okay? Step number 3, after you've got money in there and you made the account, now you need to buy an asset, okay? 2 main types of assets that we'll see in the market are stocks, and I mean individual stocks, and then ETFs. Let's break down each one of those. Stocks. This is what you think of when you see the stock market. You see those little numbers and those little letters on the screen. So these are companies that you can buy an ownership into. And the way you buy an ownership into these is with something called shares, okay? So a share is a very small percentage of that company, and that share represents ownership in that company. So let's say some of the biggest companies in the world, Apple, Amazon, Nvidia, Berkshire Hathaway, you might have heard of these before, Tesla, BlackRock, some of these big dogs, okay? You can find all the different publicly traded companies. I'm just trying to think of ones that people have definitely heard of. Apple and Amazon are definitely ones we've heard of before. So if I wanted to go buy Apple shares, or Apple stock, I should say, I would need to buy shares of Apple stock. Some brokerages, some investment firms, they allow you to buy fractional shares, which means I could buy like 0.1 of a share if I don't have enough money in my account to buy an entire share. Not every brokerage account allows you to do that. Some only let you do like 1 share minimum, and you could do, whole numbers only, 1, 2, 3, 4, 500, 672. So sometimes it's only whole numbers. Sometimes they let you do fractional shares, which would be like 0.1 of a share, 0.2 of a share, 0.5 of a share. You just got to do the research on your specific firm that you're going to go with whenever you're buying stocks. That said, if I'm going to buy a whole share of a stock, Apple trades around like $150, somewhere around there. Depends on the day, right? So Apple's trading around $150. If I wanted to buy 1 share of Apple stock, I would go through and I would buy 1 share. It would ask me share number. I would put 1 in that. And then there's a little spot that says limit versus market order. A limit order, you set the exact dollar amount that you're okay with paying. If it goes above this limit, do not execute the order. That's what you're telling the broker. If it goes below this number, execute the order and I'll go ahead and buy my 1 share of Apple stock. If you click a market order, then it's gonna pretty much instantly fill your order, assuming it's a well-known stock and there's enough trading activity to fill that 1 share order. Okay, so limit versus market. Hope that makes sense. I don't want to talk too much about it, but regardless, you have to buy shares of these individual stocks in order to have ownership in them, or potentially fractional shares, depending on what company you're buying with. Okay, second type of asset that you can buy, which I think this would be a lot better idea for a very, very, very new beginner investor, is something called an ETF. And this is an exchange traded fund. So an exchange traded fund is traded just like a stock. The numbers move up and down just like a stock on a minute by minute basis, second by second basis. And I buy shares of this ETF just like I buy shares of a stock. So if I wanted to buy something that basically tracks the market, I would go through and I want to track the market, meaning I want to just basically be invested in the entire stock market. I can go to something like ticker symbol VTI. So all the stocks and ETFs in the market are represented by these little ticker symbols. So like Apple is AAPL, Amazon is AMZN, AMD is AMD, Coke Coca-Cola is KO, et cetera, et cetera. You know, Tesla is TSLA. So it's just these little ticker symbols. That's how we represent the stock. So we don't have to say the whole company name. So for an ETF, there's the Vanguard Total Stock Market Index. All right. So if I want to be invested in basically the whole stock market, with a few exceptions, I would say VTI. Okay. VTI is the Vanguard Total Stock Market Index. There's other total stock market indexes too. That's just the most popular one off the top of my head. So if I just want to buy a little piece of every single company in the whole market, I go with VTI. If I only want to be focused on the biggest of the big dogs that are in the United States, you might have heard of the S&P 500. So I might want to buy an ETF that tracks the S&P 500. So a few examples of that would be VOO and SPY. These are both ETFs, exchange traded funds, that I can buy into that track those 510 biggest companies inside the United States. So it's called the S&P 500, if you might have heard of it before. So those are some examples. There's also ETFs that track specific sectors of the economy. So I can buy an aerospace ETF. I can buy a cloud security ETF, like cybersecurity ETF. I can buy a mortgage ETF. I can buy some specific real estate ETF. I can buy dividend focused ETFs. We'll talk about dividends at some point. So I can buy all these different types of ETFs. Probably your best bet is to go with something that tracks a very, very, very broad amount of stocks. Here's why. As a very, very beginner investors don't know that much, right? They don't know how to value a company just yet. They can learn. These are things that are very learnable, but I don't know how to value a company yet. I don't know whether or not Amazon is a good purchase at $80 a share versus $120 a share. What are the risks associated with buying Amazon stock? What do I know about the management team? What are the different lines of business that they have? What are the different business segments that Amazon has, et cetera, and so forth. So buying an ETF basically takes all of that out for me. All I'm going to do is I'm going to diversify. So if one of those 500 stocks in the S&P 500 goes to zero and it goes bankrupt, right? I'm not screwed over for that because I didn't buy that individual stock. I basically have 500 stocks that I'm tracking. So if all of them do generally okay, I'm going to do generally okay. If all of them do really well, I'm going to do really well. If all of them for some reason do terrible, sure, I would also do terrible. But in general, market's going to go up over time, assuming there's not some kind of crazy reset. So I'm probably going to get some nice steady returns with these ETFs. All right. I think I've said enough on asset types. Let's move to number 4. This is more of a personal opinion, kind of what I would want to hear if I was a younger person. After you buy your first asset, wait, relax, research, and learn. Okay, you don't need to think about, oh, whenever I get a $10 gain, I'm going to sell it. Okay, whenever I get a $100 gain, I'm going to sell it. Whenever I get a $10,000 gain, it depends on how much you start with, I'm going to sell it. Don't even worry about it just yet. Just wait. Don't look at your phone every 5 minutes to see whether or not it's going up or down. Relax, research, and learn. Okay, it's time to learn something about the market. Buying one of these broad stock market indexes like VTI or VOO, I don't have to be the most sophisticated investor to do that. If I'm going to try to buy individual stocks though, I've got to understand how a balance sheet works. I've got to understand how a cash flow statement works. I've got to understand what analyst expectations mean and whether or not they matter. I need to know something about the management team of a company, et cetera, and so forth. But if I'm just buying a broad market index fund like VOO or VTI or something like that, all I got to do is wait and relax and research and learn. I don't need to stress out about the daily fluctuations of the market or all this crazy financial news. Most of it's nonsense anyway. So just chill, it's all good. Take it slow. Don't feel like you need to get in and out. That brings me to my next point. Excuse me. Now, after I have made an account, funded that account, bought my first asset, and then chilled, waited and relaxed, watched what it did, didn't get emotional about it. I'm disconnected from the outcome. It's all good. I understand that there's gonna be fluctuations, and I'm researching and I'm learning. My next step, let's figure out a consistent amount of time that I'm gonna put in between me funneling money into my account and a consistent amount of money that I can comfortably funnel into my account. I don't want to invest money that I'm supposed to save. I don't want to invest money that I need to spend on my rent or my mortgage or my food or my cat's food or a haircut or buying toothpaste, etc. Like, let's make sure we're still being reasonable about this. I don't want to just start to put my whole paycheck in there and be reckless. Rather, let's figure out the basically smallest number that you can put in so that you can figure out how to get comfortable with putting money into the market and buying assets. So if I can put $50 a month into the stock market when I first start, that's good. That's a win, okay? You don't have to go with these huge numbers. Yes, this means it's going to go slower at first, but that's okay. You're learning, you're figuring out how to invest. $50 a month is very respectable at the very beginning. So if I can do $50 a month each month for, let's say, a 6-month time frame, that's awesome. Then I can reevaluate and say, could I bump this up to $75 a month? Could I bump this up to $300 a month? Could I bump this up to $1,000 a month? It all depends on your income, it all depends on your expenses, and it all depends on your goals and your risk tolerance, okay? So once you have enough money in the market to where the risk starts to matter, you should have been able to amass a lot of knowledge if you were waiting, relaxing, researching, and learning. So we want the first investments you make, the first 5, 6, 7, 8, 9 months to be with small money, because the truth is you're gonna make mistakes. Everyone does. Everyone makes mistakes at the beginning. Honestly, everyone makes mistakes even after the beginning. You know, it is what it is. I wanna minimize the chances that risk and that mistake I make is going to be colossally horrible. If I keep the numbers low when I'm a noob, the chances that I lose all my money in one stock, if I choose to go into individual stocks, honestly, it's pretty high. But even if you lose all your money and all you have is $1,000 in your brokerage account, you're out $1,000, okay? That's much better than if you never really learn how to do this thing and you go too fast and you wait until you have 50K. Let's say you wait 5 years and you've built up 50K and you're like, all right, now I'm gonna invest. You make one dumb investment and you lose pretty much all of your 50K. Holy crap. That would be super unfortunate. So that's why it's so important to start with a small amount of money. All right. Last one I've got here is to stay invested. Let's not try to get in and out of the market. Time in the market beats timing the market. When I say timing the market, that's a very old saying, not my saying. Sounds cool. If it was my saying, I would take credit for it, but it's not. Time in the market beats timing the market. Timing the market means, oh, I think we've gone up too much. Let me sell out because I'll try to get back in later. Or, ooh, we've got a lot more to drop. Let me sell out now. It's going to drop a lot more, and then I can get in at the bottom. That's a loser's game. You don't know where the market's going to go. If there's someone who you listen to, whether it be someone on Wall Street, someone on YouTube, someone on CNBC, anyone of your friend group, if they think they know where the market's gonna go, just give them a good old 2 thumbs up and be like, that's so cool, and then run away, okay? We don't need to be listening to someone who thinks they know where the market's going. They're wrong. I promise you, they do not know where the market's going. I don't know, you don't know. Please don't listen to anyone that says they know where the market's going in the short term. In the long term, I have faith, I have a lot of belief that the market's going to go up over time. The whole broad market doesn't mean every single stock is going to go up over time. That's why it's easier to invest in these ETFs that are broadly focused rather than to invest in individual stocks, right? Stay invested. Don't time the market. Stay invested into stocks, into ETFs that broadly track the market. If you want the next step for what I would do after this is just blank investing for dummies, right? If you would want the next step for this, let me know. I'd love to make that video on basically like step 2 of what I would do as I'm a stock market intermediate. How do I get myself up to respectable numbers in the market? What's the specific strategy? How would I do that? What would be my opinion of the best way to do that? Let me know if you want to see that. Hope you got a lot of value out of this video. Go ahead, make your first investment through Fidelity or Schwab or something like that into some kind of broad market index fund to reduce your risk so that you can chill, you can relax, you can learn, and you can start building for your financial future. All right, go ahead and subscribe if you're still here at this point. You clearly enjoyed it. Thank you so much for being here. hit that like button and let me know what you think in the comments. See you guys soon.